Hello, everybody. This is Melissa, the insurance exam queen, and this is a live boot camp for the people here, and it is a class recording for those of you who are watching later. The topics that we're covering in this section are going to be general insurance terms related concepts. We're going to be talking about policy provisions, contract law, and P&C basics. That's what we're going to be covering right now. So we're just going to start talking about insurance. And the more interactive y'all are in the comments, the better. So let's talk about why do we need insurance? So we're doing general insurance terms, and I will get you notes for all of this, but we're going to just start with a conversation instead of just looking at definitions and talking them out. So when we buy a house, right? We buy a house. There are certain things that we care about with this house and what might happen to a house. So we spend all of this money purchasing this big house that we can live in, or small house, whatever, but you got to spend a big amount of money to get a house. And then the house has the potential of getting damaged. You know, there could be a fire, there could be wind, there could be lightning, there could be hail. There's all sorts of things that could cause damage to our house and to our property. And that's what insurance is for, is we spend money on this big item, we spend money on this house, and then it's possible that things can happen to the house that would cause damage to it or break it, whatever. And we either need to have the money for that ourselves, or we need to have someone else take care of it. And that's what insurance is. So insurance is known as the transfer of risk. So we buy a house, we have the risk of it burning down. We have the risk of lightning. We have the risk of a tree falling on it. We have the risk of wind. We have the risk of hail. We have the risk of burglary. We have the risk of things happening to this house that we just spent a bunch of money on. And if we don't have a lot of extra money in the bank to be able to pay for those things, we buy insurance. So insurance is the transfer of risk. We transfer the risk of our house burning down to the insurance company. We transfer the risk of a tree falling on our house to the insurance company. Now, they're not going to be the ones burning down, and they won't be the one with the tree on them, but they will be the one to pay the bill. So the risk of things happening to our house, to our property, we transfer that to the insurance company. We let them take it. We let them handle it. And that is what makes insurance so beautiful. And all we do is pay a little deductible. Now, the things that we just talked about, fire, lightning, wind, hail, and there's a bunch of them. These things are called perils. Perils. Perils are the things that happen to our property, to us. Perils are the reason that you file a claim. So a peril is always going to be something that would make you need to file a claim. A fire happens. Fire is the peril. Hail drops all over your car, dings and dents the car everywhere. Hail is the peril. It's the reason you file the claim. You're walking down a sidewalk and a tree branch is sticking out of the sidewalk. You trip over it. The peril is the accidental injury. You tripped over the tree branch. You now have an accidental injury. So the peril is the thing that happens to us. It's the thing that causes us to file a claim. Peril is the lightning. Peril is the wind. Peril is the hail. Whatever is happening to our property and causes us to file an insurance claim is the peril. So insurance is a transfer of risk. The risk of a peril happening, the risk of fire happening, the risk of lightning happening. I transfer that to the insurance company. I let them handle it. I let them take care of the loss. Now, how is it that insurance companies can do this? If I were to say, hey, Rhonda, every time you have an emergency, let me know, I'll pay for the bill. That's what insurance companies are basically saying. When you have an emergency, you let me know, I'll pay the bill. Like, how amazing is that? I don't think we think about insurance as, oh, I'm obligated to get insurance and I got to pay this premium and they make me buy it. But what are you buying? You're buying somebody saying, hey, when you're in an emergency, I got you. I'll take care of you. I'll fix the house back up. So that's what we're getting with insurance. So how are they able to do that? How can insurance companies sign up to say, we will take care of all your major emergencies? That's what insurance is. In order for insurance companies to do this, they need to be able to know what is the likelihood of our house burning down, of wind happening, of hail happening. They need to know the likelihood of us filing a claim. And all of this is done under what we call the law of large numbers. So the law of large numbers basically says the more data that I have to look at, the better I can predict what is going to happen. So when insurance companies will look at the data of a neighborhood, how many fires does this neighborhood have? How many burglaries does this neighborhood have? How many claims are filed in this neighborhood? They will look at the data of a particular location, of a particular type of people, like 18-year-olds, teenagers. They assess teenagers and they're like, what are all the teenagers doing? Let's look at the data of teenagers. How likely are they to get into an accident? How likely are they to speed? How likely are they to whatever? That's what the law of large numbers is doing. So the law of large numbers says, let's look at the data, and from the data, we will make predictions. And the more data that we have to look at, the better our predictions can become. So the law of large numbers says the more information we have, the more data that we have to look at, the more similar exposure to loss is another way that they say it. When they say similar exposure to loss, what they're saying is we're going to look at all teenagers. All teenagers have similar exposure because they're all the same and that they're all like 18. They're all a teenager. Or they will look at just women, or they look at just men. Like insurance companies do anything that will give them data, they look at that they're allowed to look at, like even your credit report. So credit scores are an indicator to how many claims you will file. The lower your credit score, the more claims you will file. The better your credit score, the less claims you will file. So they use your credit score as a law of large numbers. Like the law of large numbers says, the lower your credit, the more you file a claim. That's what the law of large numbers has shown us. So you look at people with the law of large numbers, you look at the information, how risky are they? How likely are they to file a claim? How likely is a fire to break out in this neighborhood? And they use that to make the predictions. And then every person who buys insurance, we talk about insurance is the transfer of risk. I am transferring the risk of my house burning down to the insurance company so that if the house does burn down, they will pay to fix it. Now, when I pay my insurance premium, I'm paying a relatively small amount of money. And this is called aleatory. I pay $100 of premium a month for my homeowners, let's say. If my house burns down, they're going to pay $250,000, $300,000, whatever my coverage is, to rebuild it. $100, $250,000. Little teeny tiny $100 premium, $250,000 claim payout. That is very aleatory, unequal exchange. We pay a teensy weensy premium compared to the hundreds and millions of thousands of dollars that they will pay out for those claims. So how is it teeny tiny premium could equate to hundreds of thousands of dollars being paid out? Because of the law of large numbers and because everybody is putting money in. So we all buy car insurance. We all buy homeowners insurance. We're all buying insurance. We're all putting premium in. Not all of us, though, are going to take money out. There are years have gone by without me having a car accident. Like your car insurance is set for 6 months. If you have no accidents in a 6-month period, you didn't use your insurance, but you paid for it, but you didn't use it. So you were putting money in, but you never took it out. And that's what everybody is doing that. Everybody's buying car insurance. So everyone's putting money in. And then only some of us will actually take money out. So I like to think of insurance as a big bucket of money. The insurance company is a big old bucket of money, and everyone's paying premium in. Now, the premium that we are paying in is going to be based on our risk. If I am more likely to have an accident based on the law of large numbers, if I already have an accident, if I already have speeding tickets, if I have bad credit, if I'm living in a certain neighborhood because accidents are more prone in that neighborhood, I will have to pay a higher premium. I will be putting a bigger chunk of money in than someone else who has a good driving record. So insurance companies are really great at assessing the risk. The riskier you are, the more you have to pay. The riskier you are, the more you have to pay. So remember, insurance is a transfer of risk. I'm saying the risk of my house burning down, I want you to take it. The more likely my house is to burn down, the more money I have to pay. The more likely I am going to get into an accident, the more money I will have to pay. So it could be me, a horribly bad driver with tons of accidents on my record, and I might pay, $500 a month. Then you have someone else who's like no accidents, no bad anything on their driving record. Everything is perfect. They might pay $50 a month. Everyone will pay a premium based on the amount of risk they are bringing to the bucket of money. And that is the risk is needing to take the money out. So insurance companies are a big bucket of money, and people are paying premium in, so that if they are in an emergency, if their house burns down, if their car crashes, they're able to reach their hand into a bucket and take the money out. Like, insurance is really just saying, give us $20 every month into your savings account. And when you have an emergency, let us know. We'll give you all the money you need and more. Well, not more. I didn't mean that. More than what's available in the account. Like, if you consider, like, my insurance premium, let's say for 6 months, and in Nevada, it's very expensive. And I cannot wait, now that I am with a military veteran, he has USAA. I cannot wait to set up my insurance under him. I have been wanting USAA insurance since I was working there. And now I finally got my military man. Anyway, they have such the best rates. That's where I started working for insurance. Absolutely loved it. I was 18 years old, making so much money in insurance. It was amazing. It was incredible. I was making $25 an hour back in 2009 as an 18-year-old. Like, I was living the dream selling insurance. It was amazing. That was after hours though. I think they hired me at $13 an hour. After 6 o'clock, it became $17 an hour. And then after being there for a few years, I was up to $25 an hour. But anyway, it was amazing. So what was my point with USAA? What was that? I got off on a tangent. But anyway, insurance, you're putting money into the bucket, And if you are at risk, then you are the one who can take the money out of the bucket. So we put money in according to the risk of us actually taking it out. And insurance companies are using the law of large numbers to figure out what are the chances of us actually having to take the money out. Now, the bad driver may have to put more money in, but they may or may not be the one who actually files a claim. And that's one of the things about insurance, is that it's kind of due to chance. Yes, you may statistically be more inclined to have to file a claim, but anybody can end up filing a claim. And that's what that money is available for, that anybody can reach into the bucket and take the money out. And that's, obviously you can only reach in if you're putting money in. So you have to put money in, pay premium, pay monthly premium. Accident happens, I get to reach into the bucket and take out money. So everyone is putting money in. Only some of us will take money out for an accident and for a claim. And that's how insurance companies are able to sustain that. Now, insurance companies are so good at predicting that they make more than enough money to pay our claims and make a profit. Like State Farm kind of blows my mind. And we're going to talk about stock versus mutual here, but insurance companies, when we think of this big bucket of money, this bucket of money can be owned. So let's say I have two buckets of money. So this is State Farm and this is another company. I don't know. What, but is Country Financial mutual or stock? I don't know. I don't know. I don't have a list of them memorized. In fact, that's good for you to know with your exam. You don't need to know which insurance companies are mutual and which are stock. That doesn't matter. But I know that State Farm is mutual, USAA is mutual, Mutual of Omaha is mutual because they've got the word mutual in it, or stock. I think Progressive might be, I'm not sure. I don't think I've gotten it. I don't know. Oh, my internet just slowed down for a second. Uh-oh. Oh, okay. Let me know if I don't know if I just bleeped out, but my video slowed down for a second. Anyway, so State Farm is a mutual company. And what this means is that the people who put the money into the bucket also own the bucket. Okay, so in State Farm, they are a mutual company. The people who put the premium in own the bucket. In a stock company, which again, I don't know an example of, the people who put the premium in do not own the bucket. Someone else does. It's owned by stockholders or shareholders. So someone else, a boardroom, stockholders, shareholders, they own the bucket. Okay. So you have two types of insurance companies: mutual, where the policy owners themselves, the people who pay the premium, own the bucket of money. Then you have stock companies where the bucket of money is owned by the stockholders and the shareholders, which are not the people putting the money in. So what does this look like for us? So State Farm is so amazing that people put money in. So policy owners put money in, and the policy owners own the bucket in a mutual company. So you're putting money into the bucket and you own the bucket. At the end of the year, and this bucket of money is all for claims, right? So we all put premium in, some of us take it out for claims. State Farm, when the money is in the bucket, they invest some of that money and they make interest off of it. That is what State Farm makes. Like, that is the money that they make. They don't touch the money in the bucket other than for claims. So like the CEO of State Farm is not paid from premium. He is paid from the interest off of the premium. So they take the money that the policy owners pay in. So I pay, let's say every month, $100 State Farm, $100 State Farm. You're paying $100 State Farm. Everyone's paying $100 State Farm. That money goes into the bucket. State Farm earns an interest off of it because they put it in an interest earning account. The interest that they earn is what they use to pay the salary of the CEO, what they use to pay for the buildings, what they use to pay for advertising. They do not touch the claim money. The claim money is just for claims. And that's what makes it so magical with State Farm. That's a mutual company where they don't touch the money in the bucket. The money in the bucket is meant for the people who file the claims. A stock company, on the other hand, is owned by stockholders or shareholders. They own the bucket, and then as claims are paid, they'll use the money to pay the claim, yes. But if there is money left over at the end of the year, the stockholders and the shareholders get to keep that money. They will not give it back to the people who paid in. Over here at State Farm, if there is money left in the bucket, so let's say, they anticipate we're going to have, $5 million in claims this year based on the data. And there's 5 million, they collect $5 million of money in here for the claims, and they only spend 2 million. They had a great year, no catastrophes, no accidents, hardly anything at all. They had a great year. There's $3 million left in this bucket. In a mutual company, that money will go back to the people who paid it. A portion, like everyone will get a portion, right? Like if I paid, you're not going to get back your entire premium because there were some claims that were paid, but in proportion to what you paid, you will get whatever's left back. Okay. So in a mutual company, the policy owners, the people who pay the premium, own the bucket. And at the end of the year, if there is any money left over after all the claims are paid, it will go back to the owners who put the money in. In a stock company, you put that money in and you'll never see it again other than if you were to file a claim, because it's owned by stockholders and shareholders, and it's not owned by the policy owners themselves. So mutual companies are owned by policy owners. They issue participating policies because as a policy owner, you participate in your own policy. So as a policy owner, I mutually participate in my policy in a mutual company. In a stock company owned by shareholders, there's no participation because the policy owner who put money in doesn't participate in the ownership of the business. So there's no participation in a stock company between the policy owner and the stock company. There's no participation. All you're doing is putting money in and that's it. You're paying for your policy and that's it. Over here in the mutual company, you're paying money in, but you'll get that money back. You get to participate in the ownership of the company. You get to participate in receiving the money back at the end of the year if there is any money. Now, when we talk about, money in the bucket, both companies, let's say both companies have money at the end of the year. So people pay their premium. So let's kind of recap here a little bit. Insurance is a transfer of risk. I have the risk of my house burning down. I have the risk that the peril of fire happens. Remember, the peril is the cause of loss. I have the risk of the peril of hail breaking my car, right? I transfer that to the insurance company by paying a premium, and in exchange, they promise that if something were to happen, they will pay the premium. So I'm putting money into this bucket so to transfer my risks to the insurance company so that if a peril like fire were to occur, they will pay the bill and they will take care of it. And all I'm doing is paying a teeny tiny premium in exchange for that. And my premium is based on how risky I am, how likely I am to file an accident. So I'm putting money into the bucket, whether I'm in a mutual company or a stock company, putting money into the bucket. They anticipate how many claims they're going to have, which determines how much money they collect. So the more claims they think they're going to have, the bigger everyone's premium will be to justify that risk. And you put money into the premium bucket. At the end of the year, whatever their financial year is, they will look at the bucket and say, is there any money left over? So let's say they both have $3 million left over. In a mutual company, that $3 million in proportion will go back to the people who paid it. In the stock company, that money left over will go to the stockholders and the shareholders, the people who bought the bucket. In a mutual company, you don't buy the bucket, you are the bucket. Like as a policy owner, you make up the bucket as a policy owner and you put premium in. In a stock company, you don't own the bucket. Like I'm trying to think of this, like think about it as like a potluck versus a, what is it called? When you go to a restaurant, buffet. A mutual company is a potluck. Everyone brings food in, you all share it, and you take home the leftovers. It's your food. Y'all brought it. Y'all get to keep it. It's your food. A stock company is more like a buffet. You only get what you take while you're using it, and anything left over is not yours. You don't get to have it. So in a buffet, in a mutual company, which is more like a potluck. In a potluck, by the way, if you didn't know, is where everyone brings a dish of food. Like let's say 10 of your best friends are coming together. Everyone brings a pot of food and you put it on the table and you all get to share each other's food. That's a mutual company. Y'all bring in a piece of food. y'all pay premium in and you take what you need. And whatever's left over, you guys can divide it up. You can bring it home. You swap. I'll give you half of my potatoes for half of your stuffing. That's a mutual company, is where y'all own the food. Y'all get to keep it. In a buffet, a restaurant, you show up, you get to only take what you need to eat at that time. Nothing else about it is yours. Okay, so that's the difference between a mutual company and a stock company. A mutual company is a potluck where you bring your own food and you all get to take it home at the end. A stock company is a buffet, a restaurant where you only get to come in, get what you need, and then you don't own anything else. You don't own the food. You don't own the leftovers. It is someone else's. Okay. So when there's money left over, at the end of the year, we call that money a dividend. We call that extra money a dividend. The money that was put into claims and not used, we call it a dividend. Now, in a stock company or a mutual company, that dividend goes to the owners. So the dividend will always go to the owners. And by the way, a dividend is never guaranteed, because in my example, we've been saying there's money left over, but it's possible that there is no money left over, that they may anticipate, well, we'll have 5 million in claims, but then they had a crazy year, lots of hurricanes, lots of natural disasters, all kinds of stuff, and they might need to spend $6 million and they only set aside 5. Well, then they have to tap into their savings and their reserves and stuff like that. So dividends are never guaranteed. So it's not that there always will be a dividend, but if there is a dividend in a mutual company, it will go back to the policy owners, the people who put the money in. And in a stock company, if there's food left over, food or premium left over, it stays with the company. It stays with the owners of the company. Okay. So the money left over, if there is money left over, because its dividends are never guaranteed. If there is money left over in these buckets, the leftover money will be returned. It will be a return of unused premium in a mutual company. So in a mutual company like State Farm, if there is money left over, they will give it back to the people who put it in, like a potluck. You brought food, take it back. Right? You brought food, we ate most of it, but there's still a little bit in the dish, take it back. It's yours. Okay. Where in a stock company, you only paid money to access it when you need it. You didn't bring any of the food, you don't get any of it back. You only paid enough to access the money for a claim, whatever, and that's it. So anyway, the leftover money will go back to the people who paid it in a mutual company. In a stock company, that money in the bucket will go to the people who own the bucket. It will go to the stockholders and the shareholders. Now, in a mutual company, when they get that money, it is a return of unused premium. They are getting that money back to them. I paid premium. I paid $100 a month to pay for the claims. The year is over. There's money left over in the bucket. I'm going to get back some of my money. I'm going to get back some of that $100 a month. Okay. That's a return of unused premium. In a stock company, a dividend, when that money is left over and it goes to the stockholders or the shareholders and the shareholders did not put money in. They didn't put any money in. Okay. When you they didn't put any money into the bucket. They own the bucket, but they were not the ones paying premium. Remember, non-participating. In a stock company, policies are non-participating. So when I'm putting money in to pay premium, I am not participating in the ownership. So any money left over in this bucket at the end of the year will go to the stockholders and the shareholders, not policy owners. It will go to shareholders, to stockholders, not policy owners. So a dividend in a stock company is not a return of premium because it's not being returned to the people who paid it. It is going to the people who own the bucket. And for them, it is income. It is money that is coming to them that they did not pay out. They bought the bucket so that they can take what's left over at the end of the year. And they hope that you have a lot less claims. And they hope that they charge you a really nice premium so that there is money left over at the end of the year and they get to take it. So in a stock company, the money left over in the bucket is a dividend that goes to the stockholders and the shareholders, and they call it an income. It is an income to the shareholder, to the stockholder. It is money that is coming into them that they did not have before. So what does the government do when you have income? They tax it. Any income coming in needs to be taxed by the government. So in a stock company, when a shareholder gets dividend money, they will have to pay taxes on that money. Any income you earn from when you're in America, any income you earn is going to be taxed. So in a stock company, when the stockholders receive that dividend at the end of the year for any money left over in the bucket, it is income to them and they have to pay taxes on it. In a mutual company, as a policy owner, I got my paycheck, which has been taxed. So my paycheck was taxed. I take my paycheck and I use some of it to pay my car insurance premium, and I put money in the bucket. At the end of the year, if I get that dividend money back because I didn't need to use it all, that's not income. It's a return of unused premium. So in a mutual company, I will not pay taxes. I will not pay taxes in a mutual company because it is my own money coming back to me. It is a return of unused premium. Where in a stock company, it is owned by stockholders and shareholders. They didn't put the money in. So when they get the money, when they get that dividend money to them, it is income and they will pay taxes. Okay. So I'm going to do a quick little summary here of mutual versus stock. Mutual is owned by policy owners. A mutual company is owned by policy owners. A mutual company issues participating policies. You participate in the ownership by buying a policy in a mutual company. And in a mutual company, you will not pay taxes on the dividend. There are no taxes on the dividend. So again, mutual, owned by policy owners. No, so babe, can you turn that down? Distracts me, I'm sorry. My brain is too squirrely. So in a mutual company, it's owned by policy owners. Shit, what was the middle one? Let me take a sip of coffee. Sorry, I don't mean to curse, but at least I get to do that because I own my own business now. Mutual company is owned by policy owners. They issue participating policies, no taxes on the dividend. Stock company is owned by shareholders. They issue non-participating policies, and there are taxes on the dividend. Okay. All right. Now, so let's do a quick recap of what we're talking about. My goal right now is to talk through the general insurance without, again, trying to focus on definition. I have a YouTube video that does definition. So you can have, both if you want that. But I feel like telling stories and things makes more sense. So I'm just going to recap my story to see where we're going next. So you buy a house, you buy a car, you have risks that can happen. The risk of a house burning down, the risk of hail hitting your car. You transfer that to the insurance company. You let them be the one to take care of it if that were to happen. In order to figure out what you're paying to transfer that risk, they use the law of large numbers, which is figuring out how risky you are. They're looking at predictions and statistics to find out the actual prediction of you filing a claim. Insurance companies are either stock or mutual. So when you pay that money into the bucket, you pay your money in according to the law of large numbers, you pay that money in. If you are a mutual company, that money can come back to you in the form of a dividend, because in a mutual, you have a participating policy, you own the company, and any dividend is return of unused premium. If you are paying into a stock company, it is owned by shareholders. There is no participation in the policy, and any dividend money will go back to the stockholders or shareholders, and they will have to pay taxes on that. Now, we did also talk about, like, fire is the peril of fire, the peril of hail. Those perils are known as the cause of loss, the reason that we file a claim. Now, and then another word that you need to know when we think about peril is the loss. Loss is the reduction or disappearance of value. So loss is the reduction or disappearance of value. Now, let's talk about perils. So let's come back to the idea of, fire and lightning and wind and hail being a peril. Now, since this is a property and casualty boot camp, we can also talk about open peril versus, well, actually, I won't get into that yet. Never mind. We'll talk about that in a minute. Okay, so a peril is the fire, the lightning, the wind, the hail. Now, the peril is it actually happening, like the fire has actually happened. Prior to a peril, you may have what is known as a hazard. So a hazard is something that increases the chance of a loss. So a hazard increases the chance of a loss. It makes it more likely that the peril were to occur. So a hazard increases the chance of a loss. A hazard increases the chance that a risk were to occur. It is important to understand the hazard is not the loss. The hazard is not the peril. The hazard leads to the peril. So the hazard, for instance, may be gas cans next to rags in a hot garage. That is a hazardous situation because the gas cans and the rags could ignite into a fire. But until it's an actual fire, it's just a hazard. So a hazard doesn't mean a claim has happened. A hazard means a claim is more likely to happen, but it hasn't happened yet. The peril is it officially happened. The fire actually burned. Whereas a hazard is it's just likely for it to happen. The peril is it did happen. It has happened. Now, so a hazard increases the chance of a loss. A hazard increases the chance of a loss. Now, there are three types of hazards that we need to know. So there are three types of hazards we need to know. There are physical hazards. Physical hazards are things that we can see or touch in our environment. It's the fire, the lightning, physical hazards are the things that we can see or we can touch. It is the rickety railing on a stairwell. It is the gas cans next to the rags in the garage. It's the things that we can see or touch or interact with. It's material and structural. I could see that the staircase is falling apart. That is a hazard. I could see the ice on the sidewalk. That is a hazard. If I walk on it, I am likely to slip and trip. Okay. I could see the tree has fallen into the road, and it is a hazard because cars can hit it. Okay. So physical hazards are things that we can see or touch. They're material, they're structural. Then you have a type of hazard called a moral hazard. Now, a moral hazard is not something that you can really see. It's more of like lying. A moral hazard is lying. I'm lying on purpose. A moral hazard usually, and honestly, the only example that I have really seen them use is a customer lies on their insurance application. So when you call an insurance company to transfer the risk of your house burning down, they're going to ask you questions about you, about your house, about all kinds of things. When you lie to them about that, closer to the internet, just take like a 5-minute bathroom break. And I know I clicked out there. So 5-minute bathroom break. I'm going to move my desk and we'll be closer to the internet. 1 second. Okay, so we were talking about moral hazards. So moral hazards is lying, and you're generally lying on purpose. Like you have your insurance application. So a moral hazard, where physical hazard is something that you could see or touch. It's, you know, the gas cans next to the rags in the garage. I could see that. I could touch it. I could fix it. I could interact with it. That's a physical hazard. A moral hazard is someone who is lying, and you're lying on purpose. Like, you know, you're lying, you know, you're trying to like save money, like with the insurance company, for instance. So like, when you buy insurance, when you're getting car insurance, when you're getting homeowners insurance, you're transferring your risk to the insurance company. And we know that the riskier we are, the more premium we have to pay. So you might want to lie to the insurance company so that you don't look as risky. Say, oh, I've never had an accident. Oh, I've never filed a claim. Oh, I'm a great driver, even though you may be a horrible speeding ticket accident driver. You lie to the insurance company to get a cheaper premium. That is a moral hazard. Because remember, a hazard is something that increases the chance of a loss. And the insurance company has this big old bucket of money that they're trying to make sure that everyone puts it in and only some of us take it out. Well, if you're lying about your probability of taking the money out, they're not going to be able to collect enough premium. They're not going to be able to handle all of the claims. They need us to tell them the truth so that they can have the best predictions, so that you're only paying for the risk of you actually taking it out. Insurance is quite beautiful in a way. Like, you only pay if they have all the right data and everyone is honest with them. And if you are a bad driver, you will have to pay more, but you're paying for being a bad driver. Like, you're paying for that. If you're a good driver, you would be paying a lot less. They analyze us on our potential of taking money out. And the bigger your potential is for taking money out, the bigger your premium. But when you lie to them, they don't have the right data and they're not collecting enough money, and it increases the chance that claims will be filed when people lie. So that's why a moral hazard is a hazard. Like, you're lying to the insurance company, you're making it's more likely that you're going to file a claim based on what they assumed according to the lie, the data that you gave them. That's a lie. So moral hazard is lying on your insurance application. You know it's wrong. You're going to do it anyway. You want to try and save premium. So a moral hazard is lying to the insurance company, lying on your insurance application. The next hazard, so remember, we have 3 hazards. A hazard is something that increases the chance of a loss. A hazard increases the chance of a loss. And there are 3 physical things that I can see and touch: moral, lying on my insurance application. And then the last one is a morale hazard. Now, a morale hazard looks like moral, except it's got a little E at the end. So moral, M-O-R-A-L, morale, M-O-R-A-L-E. It's got a little E. And I like to think of the morale hazard as teenagers. So it's got a little E on the end. So think teenagers. A morale hazard is a person who just doesn't care. They have an attitude of carelessness. Like, whatever, man, I'm having a good time. This is fun. I'm going to do this. Speeding down the road is great because the wind is in my hair and it feels so good. And I'm just going to speed. It's so fun. They're not caring about a claim. They're not caring about crashing their car. They're just having a great time. YOLO. That's a morale hazard. It's a sense of carelessness. It's an attitude of indifference. It's whatever. There's people who try to help others, and then there's people who are just like, no, whatever. That's a morale. That's whatever. Like, whatever happens, happens. Not my problem. That's a morale hazard. So to the insurance company, someone who's indifferent like that someone who's careless like that is more likely to file a claim. If you don't care that speeding can hurt you and you speed down the road all the time, you are way more likely to file a claim than someone who is cautious with their speed and drives at a safe, speed limit. Okay, you're more likely to file a claim if you care less. So a moral hazard is someone who has a careless attitude, and it increases the chance that a claim is going to be filed. Okay, so again, repeat summary. A hazard is something that increases the chance of a loss. A hazard increases the chance of a loss. A physical hazard is something you can see and touch, material and structural. A moral hazard is lying on purpose to the insurance company. And a morale hazard is a sense of carelessness and attitude of indifference. Ooh, and one thing about a morale hazard as well, they get a little bit tricky with this one because they'll say something like, we want to smoke and drink because we're going to die anyway. Smoking and drinking are physical hazards. You are increasing the chance that you have a claim on your physical body. Think of health insurance. I know we're thinking property casualty, but imagine health insurance means if you have health insurance, you're covering your body. Smoking and drinking is a physical hazard to your body. It increases the chance that you need to file a claim. But they ask a question, they'll say, we want to smoke and drink because we're going to die anyway. That changes smoking and drinking from a physical hazard to because we're going to die anyway into a morale hazard. And the answer becomes a morale hazard because it's not what they're actually doing. It's the carelessness behind it. So when they talk about an attitude or carelessness, that is morale. Morale is all about carelessness and attitude of indifference, whatever, man, YOLO, do what I want. That's a morale hazard. So we're going to smoke and drink because we're going to die anyway. Makes that question a morale hazard. Okay, so those are hazards. So we have a peril, which is, remember, a peril is the cause of loss, the reason we file a claim, and a hazard makes a peril a lot more likely to occur. Okay, now when we go to buy this insurance policy, when we say we have a house and we have the risk of a peril happening, the risk of the house burning down, we want to transfer that risk to the insurance company, let them handle it. We are buying a contract with them. So it's literally a legitimate legal contract. When we say we have the risk of burning our house down, please take this risk, that is establishing a contract between the insurance company and the insured. And it is important for us to know all 4 elements of a legal contract. So there are 4 elements of a legal contract. And since every policy is a contract, so whether it is life insurance, health insurance, car insurance, homeowners insurance, it is a legal contract, okay? We must know the 4 elements of a legal contract because you will be asked, what are the elements of a legal contract? And then you will be asked not only to name them, but to know what they are, okay? So first we have agreement. And honestly, they're not number 1, number 2, number 3, number 4. They're kind of all happening at the same time, not one before the other. You just need to have all 4 elements in there. So the first one is known as agreement. Now, agreement is known as offer and acceptance. So when you're in agreement, someone has made an offer and someone has accepted it, and now we're in agreement. So agreement is known as offer and acceptance. Agreement is known as offer and acceptance. And when we are in agreement, someone has made an offer, someone has made an acceptance, and now we are in agreement. Okay. So agreement is known as offer and acceptance. Agreement is known as offer and acceptance. Now, then we need to know what is offer and what is acceptance. So this is a 3-pronged definition. 1, you need to know that agreement is known as offer and acceptance. Agreement is known as offer and acceptance. Agreement is known as offer and acceptance. Then I need to know what is offer and what is acceptance. Offer is when the customer offers the risk. I maybe can I have a kiss before you leave?
Well, I didn't want to disturb.
Well, if you're in an accident, I need to know I had a kiss.
Jeez.
All right, I'll see you back. Okay, that's it. Insurance Exam Queen's biggest fan. He saw me on YouTube, had me call him, and now we're in love. Love you, babe.
Don't choke on your coffee.
Love you, baby. Okay, so agreement is known as offer and acceptance. He made the offer. I accepted it. Anyway, so we need to know offer and we need to know acceptance. So offer is when we say take our risk, the risk of our car crashing, the risk of our house burning down. We are offering our risks to the insurance company. And they say, yes, we'll take them because we're willing to pay money to them for that. So we'll say, take our risk. So our offer is our risks and our premium, but for the offer, it's our risk. So the offer is submitting your application. The offer is when the customer submits an application. Remember, the application is all of your risks. This is my name. This is where I live. This is my address. These are all of my risks, and I'm offering to transfer them to the insurance company. So the offer is when the customer submits an application. The offer is when the customer submits an application. So if agreement is known as offer and acceptance, and the customer is offering by submitting an application, what would acceptance be? Acceptance would be accepting the offer, and it would be issuing a policy for all of these risks. So the application is my risks, and the acceptance is saying, yes, we will cover them. So the offer is the customer submitting an app. The acceptance is the insurer issuing a policy. The offer is the customer submitting an app. The acceptance is the insurer issuing a policy. So you have agreement is known as offer and acceptance. Agreement is known as offer and acceptance. The offer is the customer submitting an application. Acceptance is the insurer issuing the policy. I'm going to say that 2 more times because this is how we remember things. Agreement is known as offer and acceptance. The offer is the customer submitting an app. Acceptance is the insurer issuing the policy. Agreement is known as offer and acceptance. The offer is the customer submitting an app. The acceptance is the insurer issuing the policy. Okay. So make an offer, accept it. We are in agreement. Submit the app, issue the policy. We are in agreement. Okay. Then the next thing is that we need consideration. So I like to think of the offer as the proposal. Will you marry me? Yes, I will. Okay. Now that is just, you're just in agreement that you want to get married, but before you actually do, you've got to do it. And that's what consideration is. And consideration says that both parties will bring value to the other party. So we have the offer and acceptance. The offer comes from the customer. The acceptance comes from the insurer. These are the 2 parties, the customer and the company, the insured and the insurer. These are the 2 parties. Consideration says that both parties must bring value to the other party. So both parties must bring value to the other party. So not only do I bring an offer, I've got to bring value. Not only do they accept, issue the policy, they got to bring value. What is the value from both parties? Now, so again, let's say consideration, you need to know the definition of consideration. So just like agreement is known as offer and acceptance, consideration is both parties bring something of value. Both parties must bring value. Both parties must bring value. Consideration says both parties must bring value. Consideration says both parties must bring value. Then they're going to ask you, what is the value from both parties? But they're not going to use the word value. They only use the word value in the definition of consideration. So consideration says both parties must bring value. When they ask you, what does each party bring? They word it like this. What is consideration on the side of the insured? What is consideration on the side of the insurer? Basically, they're saying, what value do they bring? But they don't say it like that. They only say that in the definition of consideration. So consideration says both parties must bring value. Then they want to know, what is the consideration on both parties? The consideration that the insured brings, the value that the insured brings, the value that the customer brings, the consideration on the side of the insured, the customer, is application plus premium. The application for my risks and the money I'm willing to pay you to take them. That is consideration on the side of the customer, consideration on the side of the insured. My application of risks and the money I am willing to pay you to take those risks, so that if they do happen, you, the insurer, will pay to fix it. So consideration on the side of the customer, consideration on the side of the insured is the application and the premium that I'm going to pay you to take the risk. Okay. Now, some people get confused here because I said offer is submitting the app. And then I said consideration is the app and the premium. So this is where we get into the idea of a proposal versus marriage. Agreement is, will you marry me? Yes, I will. Consideration is, now we are giving our money. Your money is my money now that we're married. You're sealing the deal. You're making it official. So I don't have a wedding ring anymore. I'll get a new one here soon. I am recently divorced, but anyway, or getting divorced. When you have a wedding ring, you get a engagement ring. When you agree, you get one ring, the offer. Will you marry me? Yes. When you officially get married, you get a wedding band as well. Now you have two rings, the offer and now your money. Now your money is my money. We sealed the deal. Two become one. These two rings mean that we are now one, and your money is my money. Okay. So that is the consideration. That's how we separate agreement from consideration, is understanding that agreement is just the offer, and that consideration is the offer, the application, and the money. So when they ask you a question and they say the customer submitted an app, what is that known as? If all they're saying is the application, it's offer. If all they say is the customer submitted an application, the answer is offer. The proposal, the engagement, the agreement that we do want to set this up. If they say a customer submitted application and premium, now it's consideration. So it's only offer when it's just the app. Just the app is just an offer. Application and premium makes it consideration. You need two for it to be consideration. And think about the word consideration. You consider what I want. I consider what you want. We are considerate of each other. So there's two involved with consideration. I consider your needs. You consider my needs. I give you what you want. You give me what we want. Why else would you get married? You want to get married so that you can give each other things and receive things. We consider each other. We consider what the other one wants. We consider, what it is, what value can I bring to you? What value can you bring to me? I would not marry someone if they didn't bring me value of some sort. And I would hope they wouldn't marry me unless I brought them value. So consideration is bring each other value, bring value to each other. And the value, the consideration that the customer brings is app plus premium. So with offer, again, offer is just the app. Consideration on the side of the insured is app plus premium. Now, consideration on the side of the insured could also just be premium, as that's the most important part. So you have agreement or offer, which is customer submits an app. Then you have consideration, which is customer submits an app and pays premium, or just pays premium, because that's the main focus of consideration, is the value. Okay. Now, what is consideration on the side of the insured? The insurer. So both parties bring value to the other party. Consideration says both parties bring value to the other party. The value, the consideration of the insured, the customer, is app plus premium. What are we getting from the insurer? What value does the insurance company bring to the customer? The value that they bring is the promise to pay. The promise to pay. I promise that if you crash your car, we will pay to fix it. We promise that if the house burns down, we will pay to rebuild it. We promise that if you get sick, we will pay the medical bill. We promise that if your spouse dies, we will pay out the life insurance money. So what we get from the insurer is the promise to pay a claim. That's all we get until there's actually a claim, and then they pay out. We're only getting peace of mind until then. The peace of mind that if my house burns down, someone else will pay to refix it. It won't fall on me. So the value that we're getting is a promise and a peace of mind. And as you're selling to customers, that is your focus. You're like, look, I am making sure that you don't have to worry. You don't have to be stressed out. Your house burns down, I'm going to put you in a hotel. I'm going to make sure you have enough money to pay for that hotel. I'm going to make sure you have enough money to go to the restaurants when you're at that hotel. And I'm going to start rebuilding your house. We're going to take care of it. All you got to do is just go to the hotel. We'll take care of it. We have the peace of mind that your house will be rebuilt. And I've got replacement value on there. So you're going to get a brand new house if it burns down. I am selling you the most amazing peace of mind. I am selling you the comfort that if an emergency happens, you will be taken care of and provided for. You crash your car, you bring it in, we'll get it repaired, we'll tow it, we'll get that car fresh and shiny for you. Don't worry about it. All I need is a little bitty deductible. And then your car is boom, fixed. Okay. You're selling peace of mind to people. You are selling them security. You are selling them comfort. That if something were to happen, we will take care of it. You got an emergency, we got you. Okay. So you are selling that to the customer. So your promise to pay. It's the promise to pay a claim. I promise that if your house burns down, we will rebuild it. I promise that if you crash your car, we will fix it. Okay. I promise that if you get sick, we will pay the medical bill. I promise that if your spouse dies, we will pay out the life insurance. So it's a promise to pay. Okay. So let's summarize agreement and consideration. And remember, there's 4 elements: agreement, consideration, competent parties, legal purpose. We've talked about agreement. We've talked about consideration. We're going to recap these 2 and then move on to the next ones. That was a weird feeling in my hand. So agreement is known as offer and acceptance. The customer makes an offer by submitting the application of their risks. The insurer accepts it by issuing a policy, and you are now in agreement. Then that's the proposal, the engagement to really get married here. We've got to then bring value to each other. So the next legal element is consideration, which says both parties bring value to the other party. So consideration, both parties bring value to the other party. The consideration on the side of the customer, the consideration on the side of the insured is app plus premium. The consideration on the side of the company, the consideration on the side of the insurer is promise to pay. Now, the next thing that we need when we are selling insurance to someone is that they are known as a competent party. Someone who is old enough, knows what they're doing, not under the influence of drugs and alcohol, of sound mind. That is who we are allowed to sell insurance to. You should not sell insurance to someone who is on drugs and out of their mind and like doesn't know what's happening. Okay. Only sell insurance to someone who's old enough, knows what they're doing, not under the influence of drugs and alcohol. So as an insurance agent, when you are selling to someone, you need to make sure they're a competent party. Now, you're not going to get in trouble if they're not. Like what I mean by that is if you call someone and they seem totally fine and you set up the policy, but later they come back and say, yeah, I was on pain meds and I was kind of out of my mind and I didn't know what I was doing, you void the policy. You just void it as if it never happened because it shouldn't have happened. So you void it as if it didn't. Like if you ended up selling a policy to a 16-year-old, if they called and lied about their age, whatever, you sell it to them, you're not going to be punished for that, right? But we would void the policy as if it never happened. Now with competent party, they can get a little bit tricky when it comes to drugs. Recreational drugs, mind impairing drugs are all the drugs that you're not competent if you're on them. But if you're like on a daily blood pressure medicine or a thyroid medicine, that's fine. You're totally fine. It's not an issue. Okay. So they're talking about mind impairing drugs or pain meds, something that would prevent you from thinking clearly. Those are the drugs that they are referring to when they're talking about a competent party. The other thing that they trip people up on is they will talk about felons. A felon is fine. Being a felon doesn't mean you're not competent. So you can be a felon and a competent party at the same time. As long as you're old enough, not under the influence of drugs and alcohol, and you know what you're doing, you're of sound mind, you are a competent party. Being a felon doesn't change that. The last thing you need remember, there's 4 elements: agreement, consideration, competent parties, legal purpose. Agreement is known as offer and acceptance. Offer is submitting the app. Acceptance is the insurer issuing the policy. Consideration is both parties must bring value. Consideration on the side of the insured is app plus premium. Consideration on the side of the insurer is promise to pay. Anyone I'm selling insurance to has to be a competent party, old enough, know what they're doing, not under the influence of drugs and alcohol. And the last one is legal purpose. That the reason that we are establishing this contract is for a legal reason, that it's not against the law. It's not against public policy. We're not hurting anybody. So a legal purpose says that we're not going against the law. So this is like Joe Exotic. So if you're familiar with Tiger King or Joe Exotic, it's a document on Netflix. This was a guy who hired someone else to murder a person he didn't like, that damn Carol Baskins. He hired someone, he paid them money, or said he would pay them money if they would go murder someone. That is against the law. You're not allowed to murder unless you're the government. But anyway, you're not allowed to murder someone. You're not allowed to kill someone. That goes against the law. So that is not a legal contract. A murder for hire is not a legal contract. Okay. So any contract that we do establish cannot break the law. It has to be within the laws. So when they asking about legal purpose, you're seeing something about a law, something about public policy. We're not breaking the law. We're not going against public policy. There's a legal reason, legal, law, policy. Those are the key words for legal purpose. Okay. Any contract set up cannot break the law. There has to be a legal reason for it, and it cannot go against public policy. So again, a recap of elements of a contract. So again, when you are buying insurance from a company, when you are transferring the risk of crashing your car, when you have perils, fire, lightning, wind, that you are afraid might happen to you, and you say, if these perils were to occur, I want to transfer that risk to the insurance company, let them handle it. When you are doing that, you are buying a contract. You're buying a contract, and any contract has to have 4 legal elements. Agreement, which is known as offer and, let me just say all 4 of them, because that itself can be a question on the exam. So they might say, what are the 4 elements of a legal contract? You need to know all 4 names. You need to be prepared with all 4 names. Agreement, consideration, competent parties, legal purpose. 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 These are the 4 elements of a legal contract. Any contract, not just insurance. Even if this is a rental, like I'm going to rent a house, I'm going to rent a car, I'm going to get a job, I'm going to get a contract for a job. Every legal contract, no matter if it's insurance or what, every legal contract has to have agreement, consideration, competent parties, legal purpose. Okay. In insurance, agreement is known as offer and acceptance, and the offer is the customer submitting an app. Acceptance is the insurer issuing the policy. Consideration, both parties must bring value. Consideration on the side of the customer of the insured is app plus premium. Consideration on the side of the insurer is promise to pay a claim. And then you need competent parties, which says that anybody involved in the contract has to be old enough, not under the influence of drugs and alcohol, and of sound mind. They know what they're doing. And then last one is legal purpose, cannot break the law, cannot be against public policy, cannot hurt anyone. Okay. All right. Now, when you're filling out this insurance application to the insurer, you are making statements. You're saying things. You're saying your name, you're saying your address, you're saying where you live, what kind of cars you drive, what kind of cars you drive. You're saying things to the insurer. Now, the things that you say and write down on your insurance application, the things that you put down on your insurance application are either known as representations or warranties. So when I'm filling out my application, when I'm filling out that offer, I'm either making applications. I'm filling out the application and I'm either making a warranty or a representation. A warranty is an absolutely true statement. A warranty is an absolutely true statement. I drive, well, now it's destroyed. I sold it. My car broke down the middle of the desert. I drive a 2009 Toyota Prius. That is a fact. That is a statement, a factual statement. There is nothing weird, wrong. Like, that is a fact. That is a warranty. A warranty is like a fact. I drive this car with this VIN. I live at this house. That's a warranty and a fact. Warranties are generally used for property and casualty insurance. Representations, on the other hand, are used for life and health insurance. This is where what you say may or may not be true. And what we mean by that is when you're filling out an application for life insurance or health insurance, they're asking you questions like, do you have cancer? It's possible that I do and not know it, right? When I was actually 16, you can't really see it. I think Zoom has a beautifying thing on, but I have a scar right here. I was 16 and I was diagnosed with thyroid cancer. I didn't know I had it before I had it. I just knew I had like a weirdness right here, like a sore throat, like something felt like I had a ball. And then I went to the doctor and he's feeling around. I was like, oh, I think you might have a nodule here. We have to test it for cancer. We don't know that we have it until we know. So there could be a tumor growing somewhere in your body at the time that you're asked that question, and you may say no, but the answer should be yes, but you don't know that. To the best of your knowledge at this time, you don't have cancer. So a representation is a statement that I believe to be true, that I think is true, to the best of my knowledge is true, but it might not be true. I might have cancer. That is a possibility. So with life and health insurance, they do representations instead of warranties, because a warranty is must be true. And if it's not true, you void the policy, you void the contract. So again, a warranty is must be true, has to be true, absolutely true. And if it's not true, then we void the contract. A representation is, I believe it to be true. I think it's true. To the best of my knowledge, it's true, but it might not be true. And that's okay, because they don't do full body physical exams. And we can't know, as of yet, we don't have the technology to put a little watch on our wrist that tells us everything going on inside our bodies. I know that's available in movies. One day, maybe we will get that, like a little implant in our head or something that tells us everything about our body. But as of right now, we don't know that. Okay, so a warranty, a representation, I think it's true. I believe it's true. As the best of my knowledge is true, but it might not be true. That is a representation. Now, let's say that I did buy that policy. So they asked me, do you have cancer? I said, no. I buy the policy. I end up with cancer 3 months later. And they say that the tumor had been growing for the last 6 months. So technically I did have cancer when I bought that insurance, and I said I didn't. Am I covered? Yes. Yes. At the time, to the best of your knowledge, you did not have cancer, and that is totally fine. That was your answer, and that's okay. So you would still be covered. So a warranty is absolutely true, must be true, is true. And if it's not true, you void the contract. Representation, I think it's true. I believe it to be true. To the best of my knowledge is true, but it might not be true. And if it ends up not being true, I'm okay. I'm still covered. However, there is such thing as a misrepresentation. It is possible for you to lie or have the wrong information. So when you do lie, that's called an intentional misrepresentation. So you have a misrepresentation, and then you have an intentional misrepresentation. An intentional misrepresentation is lying on purpose. If you are intentionally misrepresenting the facts, you are lying on purpose, and that can void the policy. But a regular misrepresentation could just be an untrue statement. I forgot, I misspoke, I didn't understand the question. So not every misrepresentation is an outright lie. It's just an untrue statement, okay? Just an untrue statement. Now, when we're filling out this application, oh, and by the way, with representations, attach the word statement to representation. And what I mean by that, you may see an exam question that says the customer made statements on the application. What is that? Now, some people will go, well, is it true or not? If it's true, I know it's a warranty. If it's believed to be true, I know it's a representation. But they're not going to tell you that. They're just going to say a customer made a statement. They are looking for representation. So when they say a customer made a statement on the application, representation. Statement, representation, statement, representation, statement, representation. Attach the word statement to representation. Only if they say true, must be true, is true, does that statement become a warranty. But if they speak nothing of the truth, if they don't say whether the statement was true or not, if all they say was that you made a statement, representation is the answer. They have to say is true, must be true, has to be true in order for the answer to be warranty. Now, when a customer does make a, misrepresentation on the policy, if they are doing it intentionally, then what they are doing is fraud. And fraud is any time that you're trying to deceive, lie, or cheat the insurance company. Did we go after our time? I'm like on a, I'm in a different time zone. I think we're past our first break, although we did have a little bit of a internet issue. We're almost done here with general insurance. So then we'll take our break. So with sorry, I got a text here. If a customer is intentionally lying, that is fraud. So fraud is any time that you're lying, you're trying to deceive. Okay, so that is fraud, is lying or trying to deceive. Oh no, I think we have another hour. Okay, it's 10:30. Yeah, we're good. Okay, okay. Sorry, time zone adjustments. Sorry, my little squirrel brain. So fraud is any time that you're trying to lie or deceive. Yeah, so okay, so good. This is why I'm struggling so bad. I have PST time on my laptop. I'm living in Central Time. I set the class as EST time. So I need more organization in my life or change the times on my phone and my computer. Anyway, sorry, squirrel brain all over the place. So fraud is deceiving, lying, or cheating to the insurance company. Now, some people get confused with fraud and concealment. So fraud is any time that you're lying or trying to deceive or cheat the insurance company. Concealment is a form of fraud. So concealment, you're still trying to lie and cheat the insurance company, but concealment is a way of doing it by specifically withholding or hiding information. Concealment is a type of fraud that says, I'm going to lie and deceive you by not telling you certain things. Concealment is like a lie of omission. Okay, concealment is a lie of omission. I'm going to hide the fact that I have cancer. I'm going to hide the fact that I've had car accidents before. I'm going to hide the fact that I'm a bad driver. That is concealment. So fraud is trying to deceive and lie and cheat the insurance company, and concealment is a form of fraud specific to withholding or hiding. So in order for the answer to be concealment, you need to see withholding or hiding. You are withholding or hiding information from the insurer, which is a form of fraud. Okay, so fraud is anytime I'm lying or deceiving. Concealment is specific to withholding and hiding in order to lie and deceive. Okay. Okay, so again, we're filling out that insurance application, which is known as the offer. Remember, the offer is filling out the insurance application. I am giving my risks away to the insurer. I'm saying, you take these risks for me. I will pay you a premium for it. I'm giving you that consideration. I'm giving you that value. I'm giving you money to take these risks. Okay. And in order to do that, I'm filling out that application. I'm either giving representations if it's life or health. I believe it to be true. I think it's true to the best of my knowledge is true, but it might not be true. That's a representation, which we also attach with the word statement. And then you have warranty, which is used for property and casualty. This is absolutely true, must be true. And if it's not true, you are voiding the policy. That is a warranty. And fraud is any time that you are trying to lie or deceive or cheat the insurance company, specifically usually on that application. Or fraud is another time that we commit fraud is when we file an insurance claim and it's wrong. But there's two times we generally do fraud. At the beginning, when we're filling out the application, we may lie and deceit, whatever, or when we're filling out a claim. But anyway, fraud is anytime that we're trying to lie, cheat, or deceive, and concealment is specific to withholding or hiding information. It is a form of fraud. It's not separate from fraud. It's a type of fraud. And it's a type of fraud that focuses specifically on withholding or hiding information. Okay, now there's also, so we talked about a legal contract, and that agreement is known as offer and acceptance. And we talked about the offer. We talked about that application, how it's got warranties or representations or whatever. Now I want to talk a little bit about just some insurance specific to insurance contracts, things that are unique to an insurance contract that may not be a part of a rental or a job contract. Okay, so these are not the 4 elements of a legal contract, but they are unique to insurance contracts. So the first thing, we've already talked about this before, was the aleatory, however you want to say that word, both work, potato, tomato, doesn't matter. But that is that unequal exchange. I pay my life insurance, for instance, is $28 a month, a teeny tiny premium. But if I were to die, my family would receive $250,000. $28, $250,000. Very, very unequal. 20, it's like a penny to like, well, yeah, penny to like $100 bill. Very unequal. That's not the percentage, but $28, $250,000. Very unequal. That's why I like to think of like the scales of justice, you know, like the little weights. It's always unequal. So the memory trick here for aleatory is to think about those scales of justice like a seesaw. Like if teeter-totter seesaw, you know, like when a kid, if you have a seesaw, right? Like it goes like this and a kid sits on this side, a kid sits on that side, and you seesaw back and forth. In insurance, it's always like this, where the customer pays a teeny tiny premium and the insurer has to pay the most. Okay. But when we think of the word aleatory, we get the idea of that seesaw or the justice scales going back and forth. It's never equal. It's never equal. It's always going some direction. And for the insurance company, it's always teeny tiny premium from the customer, huge claim payout from the insurer. So with aleatory, this one will usually come in they're going to ask it two different types of ways. One, they're just going to ask you, what does aleatory mean? Unequal exchange. Aleatory is an unequal exchange. It is unequal to pay $28 and for my claim get $250,000. It's very unequal. Okay. The other way that they will talk about aleatory or aleatory is in the form of an example. And that would be like, John pays $100 a month for his insurance. He paid $200 a month and then he died. His life insurance payout for that $100 a month premium was $250,000. What does this represent? That's how they will word it. They will say, Sam paid $100 a month on the premium. They only paid that for 2 months before they died. They got $200,000 payout. What does this represent? So it always comes in the form of a story about someone paying premium and then getting a claim payout. What does this represent? Aleatory, an unequal exchange. My life insurance is $28 a month. And it's good for 30 years. I have a term insurance that's good for 30 years. And if I die at any point during this term, $250,000 will pay out. Even if I pay $28 every month for the next 30 years, it will not add up to $250,000. It won't. It is very unequal. So even if I paid every single month, $28 every month for 30 years, it will not equal $250,000. So insurance is an unequal exchange. Aleatory is an unequal exchange. Customer pays a tiny premium, insurer pays big claim out. Teeny tiny premium, big claim payout. Aleatory, unequal exchange. And be prepared for a scenario question. So-and-so paid this much in premium. They got this much in claims payout. What does this represent? Aleatory, unequal exchange. Okay. All right. Then we've got adhesion. When we buy an insurance contract, there is adhesion. And adhesion means sticky. It sticks to. You adhere, you stick to it. There are two sides for something to stick to, okay? One side is the insurer has to stick to what they said. If they say they're going to cover you if XYZ happens, they need to cover you if XYZ happens. They need to stick to what they said. Now, the insurer is also the one who wrote the contract, which is why they have to stick to it. They said it, they promised it, they need to fulfill it. So if they wrote, we will cover you for this, they must cover you for that. They have to stick to what they said. They're the ones who wrote it out. They are the ones who decide the wording. They're the ones who decide what it is they're going to say. They're the ones who decide what they're going to cover, and they have to stick to that. The other side of the stick, because you have to adhere to it, is the customer has to buy all of it or none of it. You can't say, well, I only want this and I only want that. I don't want any of this. I want you to give me this part of the contract and I want this part of the contract, but I don't want this. Take it all or nothing. All or nothing. Adhesion says, if you are going to buy this policy, which the insurance company wrote, and they have to stick to what they said, you have to stick to all of it or none of it. You can't say, I only want this section and I only want this section, but delete the middle. All of it. You have to take all of it. Okay. Yeah. So adhesion, the insurer has to stick to what they said. The customer has to buy all of it or none of it. Now, of course, you can add or remove certain coverages. Okay. I can add towing and labor to the car. Okay. Some people may not have towing and labor. When we say stick to all of it, if I don't have towing and labor, I'm not sticking to that because it's not part of my policy. But if I were to buy towing and labor, whatever is written on my contract for towing and labor will be the same exact words that are written on your contract if you buy towing and labor. Like when we say that you have to stick to what we said, they also can't change what they said. Like I can't be like, well, I want to add towing and labor, but can you delete the second sentence from that paragraph? Because I don't like it. You buy all of that coverage or none of that coverage. You buy all of that contract or none of that contract. You don't get to change the wording. Only the insurer gets to decide the words in the policy because they're the ones who have to fulfill that promise. And as a customer, you either stick to it or not. Okay. So when we say take it all or leave it all, I'm not saying you have to take every single coverage, but of the coverages that you do take, whatever is written for that coverage, you have to take all of that. You can't delete paragraphs or change up some wording for you. Your wording is the same as everyone else's wording. Okay. That's why like policies are called forms. You may have like read this word in your studies and you see the word form and they don't really like broad form, basic form, special form. When you think of a policy, think of something, it's already written, it's already typed up, it's ready to go. And it's a form, it's like a blank form. Like imagine you go to an insurance company and they've got all these forms on the wall and you say, I want the best policy, the best coverage for homeowners. They're going to pick up an HO5 form and then they're going to put your name on it. And now it becomes a policy. The form is already typed up. The way that the coverages works is already typed up. The way that the coverage pays out is already typed up. The way that they do replacement costs on the house is already typed up. Because they have to get that when they create a form. And remember, a form is what becomes a policy after you buy it. A form becomes a policy after you buy it. They have to get that policy form approved by the Department of Insurance in that state before they're allowed to sell it. So they have to have basically a blank policy all typed up. That's a form. Is a policy that nobody owns. It's a blank, it's blank, but it's kind of like fill in the blank where it'll say name of the insured blank line. And then it will list out all the rules, all the things about an HO5, a homeowner's HO5, because that's the best one. Then they fill in your information. So a form is like a fill in the blank policy that's not active yet until you officially buy it. So anyway, that when we say aleatory, that form is the same for everyone. And the only difference is putting in your name and your unique characteristics of your house, but everything else will be the same. And you can't ask them to change the form for you. All they can do is fill in your information and that's it. Okay. I'm trying to think of an example for that, but I think we're good. Okay. All right. What else? Also unilateral insurance policies. So insurance contracts. Not only do insurance contracts have all four elements: agreement, consideration, competent parties, legal purpose. They also have adhesion. You have to stick to what they said. They're also aleatory, unequal exchange. They are also what is known as unilateral. Unilateral. Unilateral is a one-sided promise. Unilateral is a one-sided promise. And when we go back to consideration, consideration said both parties must bring value to the other party. And the consideration on the side of the insurer, the insurance company, is promised to pay. So unilateral says one-sided promise. An insurance contract is a one-sided promise. Two people, but only one side is making a promise. And if consideration says that the insurer is making a promise, unilateral is for the insurance company. They are the ones that are making the promise. They are the only ones making a promise. So when I buy an insurance contract, the insurance company is promising me that if I file a claim, they will pay for it. That if I have a valid claim, they will pay for it. Only the insurer is making a promise. They are promising that if I file a claim, that if my house burns down, that if my car is destroyed, they will pay for it. Okay. And because only it's a one-sided promise, only the insurer is legally bound to do anything. Only the insurer is legally bound to do anything. As a customer, I pay premium. I am not legally bound to it. If I decide to stop paying my premium, the policy cancels, it's over, we move on. Nothing, and they're not going to take me to court. They're not going to sue me because I failed to pay my premium. They're just going to cancel the policy and move on. I am not legally bound. I am not making a promise as a customer. The customer is not legally bound. The customer is not making a promise. The insurer, though, is. The insurer is promising that if I file a claim, they will pay it, and they are legally bound to do so. They are legally upheld to that promise. So if I file a valid claim and the insurer says, we're not paying it, I am going to sue them. I'm going to take them to court, and a judge will make them pay because they are legally bound by that promise. That's what unilateral, sorry, I got an itch in my nose. That's what unilateral is a one-sided promise that they are legally bound to do. So the insurer is saying, I promise that if you file a valid claim, I will pay it. And if I don't, you can take me to court and sue me, and the judge will make me pay. That is unilateral. Unilateral is a one-sided promise. Only the insurer is legally bound to do anything. Unilateral is a one-sided promise. Only the insurer is legally bound to do anything. The customer is not legally bound. You fail to pay your premium, whatever, move on. No big deal. Well, it could be a big deal for you, especially if you have a car accident and you have no insurance. But legally, the courts don't care. Okay, so again, we have our insurance contract. We've got the four elements. We've got adhesion, aleatory, unilateral. Insurance contracts are also known as conditional. Conditions, a condition is like a rule. So like everyone says, I want unconditional love. Unconditional love. That means that I want you to love me no matter what I do or who I am or what I say. I want you to love me. No rules. Okay, that is unconditional. So conditional then means that there is a rule. That certain rules, certain duties, certain procedures must be met, or this is over. Okay. So conditional says both parties have rules, duties, obligations, ways of behaving. Insurance contracts are conditional. Insurance contracts have rules. And if you don't follow the rules, the policy doesn't work. If you don't follow the rules, the policy doesn't work. You must follow the rules. Now, both parties have rules. So when we say parties, insured, and insurer, both parties have rules. Insured and insurer, both parties have rules. For instance, one of the rules is if you have an accident, you need to tell us quickly. Now, every state's a little bit different, but usually it's like 30 days to file a claim. Within reason, tell them as soon as you can. And then the insurer has rules about how quickly they must respond to that claim and how quickly they must pay you. So both sides have rules. It's not only the customer has to follow rules, they both have to follow rules. So both parties have rules. Both parties have duties. Both parties have obligations, okay? So conditional is just saying that this is a conditional contract. It only works if we follow the rules. And you must follow the rules. And if you don't follow the rules, it doesn't work, okay? So condition, both parties have rules. Now later, we're going to learn parts of a policy. Right now, we're learning like parts of a contract, like what makes a contract a contract. Later, we're going to learn parts of a policy. Now, an insurance contract itself is conditional. It has rules. When we learn about a policy, though, we're going to learn that there is actually a part of the policy called conditions. And that's what you're going to be tested on the most. Not that an insurance policy is conditional, but that the policy itself, what are the conditions in the policy? The policy itself has rules and duties and obligations. When they ask about conditions, those are your key words to know that the answer is conditions, rules, duties, obligations, ways of behaving. Those are the conditions, okay? If the question says, where do we go to find the rules? Conditions. Where do we go to find the duties? Conditions. Where do we go to find the ways of behaving? Conditions. The rules, duties, obligations, ways of behaving, procedures may even be a word that they throw in there. The answer is conditions, okay? So insurance contracts, again, adhesion, stick to what we said, aleatory, unequal exchange, personal, it's between the insured and the insurer, unilateral, one-sided promise. Oh, I didn't talk about personal. That's the last one. Personal is just that the policy is between you and the insurance company. It's a personal contract. No random stranger can call in and start talking about your policy. It's personal. It's between you and the insurer, okay? And then we have unilateral, the one-sided promise, and then okay, we lost it again, but like I said, we're getting that ether cord. Thank you for your patience. Technology, man, you gotta do your best. Okay, so I'm glad you guys are all here. Okay, all right, and then I wanted to make sure I check my things if anybody else is struggling to get in. Not seeing anything. Okay, cool. Okay, so what were you talking about? Unilateral, conditional, conditions. Okay, all right. What I want to do now is share screen. Okay, so these are the general insurance notes. So like I said, I kind of wanted to do things differently for this recording. where I didn't just want to pull this up and just start talking about all of these things. I wanted to tell it like a story. So now though, I want to make sure we hit everything and I discuss anything that we haven't yet talked about. And again, if you want a video that's more just definition after definition after definition, there is a free YouTube video on the general insurance topics. But so now we're just going to make sure we hit everything else as part of general insurance. And then we'll be set for our break here. We might run a little bit over, but we'll cover everything here. Okay. So we talked about how insurance is and can somebody just say hi to make sure we're back, that everything's okay since the internet bleeped out? Okay.
Hi.
Thank you. Thank you. Okay. So we talked about how insurance is a transfer of risk. And then risk is the uncertainty or chance of loss occurring. So the risk that your house burns down, it is uncertain that could happen, but it can happen. That's what a risk is. It's the uncertainty or chance of loss occurring is a risk. Okay. Now there are two types of risks. And you could definitely be asked about these. So you have, when we say that insurance is a transfer of risk, I'm going to transfer the risk of my house burning down to the insurer. I'm going to transfer the risk of my car crashing to the insurer. There are only some risks that they will take. They will not take every risk, right? There's all kinds of risks out there, like even the risk of getting married. You might get a divorce. There's no insurance on that. That's not a risk that they're going to take. They're a risk you are taking, but you can't transfer that risk. Maybe that we should have divorce insurance. That would be pretty interesting. I wonder how they would calculate the premium on that. But anyway, not every risk can be given, to the insurer. They will only take what is known as a pure risk. So a pure risk is known as loss or nothing, no chance of gain. So a pure risk is loss or nothing, no chance of gain. What we mean by this is if I'm going to get in my car and drive to my friend's house, I either get there or I crash my car. I'm not like winning anything. Either something bad happens or nothing happens. That is a pure risk. Either nothing or something bad. The insurance company will only cover those risks. They only cover pure risks. Loss or nothing, no chance of gain. Okay. The other type of risk. Oh, Sam, I'm going to give them to you. And if you want a copy right now, I'm putting them in the chat box. So if you click the link in the chat box, you can pull this document up. But they will be part, when I email the recording out, it will be part of the email in the recording. And if you're watching this recording, click the link below somewhere. It will say notes. Okay. So anyway, a speculative is a type of risk where you could win or lose. So there's loss or gain, or win and lose. For example, gambling. Okay. So speculative is loss or gain, win or lose. This is like gambling. I could win, but I could lose. There is no Las Vegas insurance. Okay. You don't go to Las Vegas and say, I'm going to buy insurance so that in case I gamble away all my money, I'll get it back. That doesn't exist. Okay. So there's no insurance for speculative losses. There is insurance for a pure risk, a pure loss. Is this, by the way, I got worried. Okay. That it wasn't being recorded because of the internet, but everything is good. Okay. So in summary, insurance is the transfer of risk. Risk is the uncertainty or chance of loss occurring. There are two types of risk. A pure risk is loss or nothing, no chance of gain. Only a pure risk is insurable. And then there is a speculative risk, which is lose or win, loss or gain. And that is like gambling, and insurance companies will not insure a speculative risk. Okay. Good. Now, insurance is the transfer of risk. but there are other ways of handling risk. Insurance is one way. We transfer it to someone else. We let them deal with it. But there are other ways of handling risk. And this can be part of your exam. It's not in everyone's materials. If, like I said, I teach to the main stuff, but every state could be a little bit different. So this may or may not be in your materials, but either way, it's good to know to help you understand stuff. So there's many ways of handling risk. Insurance is just one way. And insurance is transferring. You transfer the risk, okay? But you can do other things. And our memory trick here is I am a star at handling risk. I'm going to make the notes better here. I am a star at handling risk. That is our memory trick. I am a star at handling risk. S-T-A-R-R, okay? I am a star at handling risk. Now, it is more important for you to remember these words than to know what each one means. So keep in mind, the exam is 70%. You don't need 100% to pass. Some states are 80, like Nevada is 80, Michigan is like 72, 73. Most of you only need a 70. You don't need to know it all, okay? 100% would be knowing the definition to every single one of these. 70% is remembering that I'm a star and I share, I transfer, I avoid, I retain, I reduce. That's what you need to remember. I am a star at handling risk. I share it, I transfer it, I avoid it, I reduce it, I retain it. I am a star at handling risk, okay? Now I'm going to describe each one briefly, just so you know. So transfer, T, is insurance. You transfer to someone else. Sharing is kind of like being married, where you know the person, and there's like formal sharing groups. Sharing is very similar to insurance. It's almost insurance, except you know the people. Where insurance is everyone doesn't know each other, but we're all paying money in and we're all sharing this big bucket of money. That's what sharing is, except you actually know the people. So when you get married, you are sharing in the family bills and maintaining a house and feeding the family. You're sharing that. You're not taking it all on your own. There's someone else involved in handling, running a household with you. So with sharing, it's like the same way. It would be like you and your 10 best friends get an emergency savings account, and all of you put $100 in every month. And then if one of you has an emergency, you take a vote. And if you say, okay, we believe that you should be able to use this money for your emergency, you cash the money out, you give it to them, you shared in the risk. So you guys are sharing that. Then we have avoidance. Avoidance is it's a way of handling risk by trying to avoid the risk. I can't crash my car if I don't own a car. My house can't burn down if I don't own a house. I can't get sick if I never leave my house. You're trying to avoid it ever happening. But that is like so hard to avoid everything that might happen, because then you're not even living. So they do like to say how transfer is the best way of handling risk and avoidance is the worst way of handling risk, because you can't avoid everything. Reduction is wearing a mask so that you don't get sick. Okay, you're trying to reduce the chances that you get sick. I love how many examples COVID has given me now for teaching that we didn't have before. So anyway, but reduction is you're trying to reduce the chances that you get sick. So avoidance would be like, I'm never leaving my house. Reduction will be, I'm going to wear a mask and wash my hands. I have to leave the house. I can't avoid everything, but I'm going to try reduce the chances that I get sick. That is reduction. Or it could be, they say so-and-so exercises and works out. What are they doing? They are trying to reduce the chances that they get sick. They're trying to reduce the chance that they file a claim. Then you have the next one, which is retention. When you think of retention, You want to think of a deductible. A deductible. You are retaining. So retaining is to keep. Retention is to keep. A retaining wall holds back water. Water retention in your body means that you're keeping water weight. Retention is to keep. So you can retain the risk. You can keep the risk. Now you can keep all of it, or you can keep some of it. Self-retention or self-insurance would be keeping all of it. A deductible would be keeping some of it. When you have car insurance and you have a $500 deductible and you crash your car, you have retained, you have kept the first $500 of the risk, and you give the rest to the insurance company. You transfer the rest to them. So retention is keeping some or all of the risk. You are self-insured if you keep all of it. You have a deductible if you keep some of it, but you are retaining some of the risk. Okay. So retention is either self-insurance or a deductible. You're keeping some of the risk. So again, I am a star at handling risk. I share it. I transfer it. I avoid it. I reduce it. I retain it. I am a star at handling risk. Okay. Then we have exposure. This is not in everybody's state exams, but exposure is the unit of measurement to determine rates for the insured based on how risky they are. Basically, exposure is how many accidents have you had? How many claims have you already filed? How good of a driver are you? How unhealthy are you? How sickly are you? That is your exposure. And your exposure will ultimately determine your premium. So the more risky you are, the more exposure you provide the insurer, the more premium you will have to pay. Okay. We talked about hazards. Hazards increase the chance of a risk occurring. Physical hazards are material and structural things that you can see and touch. Moral hazards is lying on purpose, like lying on your insurance application. Morale hazard is a sense of carelessness. We talked about loss and peril. So peril is the cause of loss, the reason I'm filing a claim. Loss is the reduction or disappearance of value. So the peril leads to the loss. The peril is the reason for the loss. The fire destroyed the value of the house. The peril of the car crash destroyed the value of the car. So a peril is the reason for the loss. The loss is the reduction of value. Okay. We talked about the law of large numbers. The more data you have, the more stats you have, the more predictable actual losses will be. We didn't talk about reinsurance yet. Reinsurance, and in fact, a better place to put this would be after, just think about it. It's not really, it's kind of a weird word. Kind of goes with certificate of, well, not really. Yeah, we'll put it here. Trying to better organize stuff to make it make more sense. Anyway, but reinsurance, yeah, well, okay. Yeah. So law of large numbers, we got that. Okay. Certificate of authority. So we talked about how insurance companies are either stock or mutual. Well, before that, they have to get, whether they're stock or mutual, doesn't matter. They need to have permission. So that's what a certificate of authority is. When an insurance company, whether you're stock or mutual, doesn't matter. If you're an insurance company and you want to be able to sell in this state, you need to get a certificate of authority that says I'm allowed to sell in this state. So if your certificate of authority is an insurance company going to the Department of Insurance and saying, we want to sell in this state. And if you want to sell in this state, you get a certificate of authority. The certificate of authority makes you admitted and authorized. So a certificate of authority makes an insurance company admitted. You are now admitted to be able to sell. You now are authorized to be able to sell. So a certificate of authority is what an insurance company needs to be able to sell insurance in that state. And once they have a certificate, they are known as admitted or authorized. Then they want you to know that admitted means authorized and authorized means admitted. So admitted means authorized, authorized means admitted. There is no such thing as certified. So when they say a certificate of authority means that a company is, you're looking for the answers that are admitted or authorized. You are not looking for certified. I know they got the word certificate in there, never ever certified, admitted or authorized. Certificate of authority is admitted or authorized. Certificate of authority is admitted or authorized. Certificate of authority is admitted or authorized. And admitted means authorized, authorized means admitted. Because they may say an insurance company is admitted. What does that mean? It means they're authorized. An insurance company is authorized. What does that mean? It means they're admitted. Whatever reason, they do that. Okay. All right. We talked about stock and mutual. These are the most important bullet points. So we said stock is owned by shareholders, issue non-participating policies, dividends are taxed. Mutual companies are owned by policyholders. They issue participating policies. Dividends are not taxed. Okay. Now, reinsurance, and in fact, actually, we need the word indemnity. The word indemnity is down here. We're going to put that up here. Actually, indemnity should go here. Thank you all for the patience of, we're trying to make better notes. And these will all be, because it's a link, when you get it, it will be in this order because this is it's automatically edited. But anyway, so peril is the cause of loss to fire the accident. Loss is the reduction of value. Indemnity is what they pay you to restore you after the loss. After the loss, there we go. After the loss. That's how it goes together. So when I have a loss, when my house burns down and the insurance company comes to rebuild it, they are indemnifying me. Indemnity is to make me whole. Indemnity is to restore me after a loss, to bring me back to where I was before. So if I have a car that's worth $10,000 and I crash it and it has $2,000 of damage, indemnity would be fixing the $2,000 of damage and restoring it back to a $10,000 car. If I have a 3-bedroom, 2-bathroom house and it burns down, indemnity would be rebuilding a 3-bedroom, 2-bathroom house. You're restoring the insured to where they were before. Now, indemnity, you're not supposed to make money. You're not supposed to like profit off of insurance. So if you have a 3-bedroom, 2-bathroom house that burns down, indemnity is not, well, we're going to rebuild you a 10-bathroom mansion. No, indemnity is 3-bedroom, 2-bathroom house, 3-bedroom, 2-bathroom house, $10,000 car, $10,000 car. You're not going to make gazillions of dollars in profit off of, the insurance. So indemnity is just to restore you to where you were before, to bring you back to whole. Okay, so that is indemnity. Now with insurance companies, when insurance companies get set up, they are, their domicile, we need to know their location of domicile. And domicile just basically means where are they at home? Where are they? Oh, I missed reinsurance, didn't I? We had to talk about indemnity first. I felt like something was weird. Reinsurance is when one company indemnifies another. So we just talked about how indemnity is to make you whole again. Insurance companies can have insurance for insurance. That's what reinsurance is insurance for insurance, insurance for insurance. So as an insurance company, if I take on a lot of risks and everyone files a claim at the same time, I could lose all of my money, right? Like I could be emptied out. One way to avoid that is by having another insurance company back you. You can literally have insurance on your insurance. So reinsurance is where one company will back another company for all or part of their losses. And the purpose of indemnity is to prevent against, or the purpose of reinsurance is to prevent, prevent catastrophic losses, taking out an insurance company. This has happened a few times. where an insurance company can be in, like something natural disaster, something crazy happens, and everyone is filing a claim at the same time. And the insurance company goes, oh my God, this is all of our money in the bucket. The bucket's going to be emptied. By having reinsurance, they're asking another insurance company to help them, and they don't have to empty their full bucket. Now you have to pay for that. You pay for reinsurance. It's not free. It's not one friend helping another. You have to pay a premium on that. But reinsurance is just making sure that you have another company that will help you if you have a bunch of claims so that you're not wiped out completely. So reinsurance is when one company indemnifies another company, and it's to prevent against catastrophic losses. So that is reinsurance. Now, another thing with insurance companies is that they are, where are they domiciled? Where are they located? That's what domicile is. Where are you located? Insurance companies have, like, what we would say a home base, and then where they're selling. Their home base is where they are headquartered, where they are incorporated, where they got founded. Any business that you start, like even the Insurance Exam Queen business, whatever state I register my business in, I get my business started in, my business will be written according to the rules of that state, because every state has different laws. Every state has different rules. So whatever state I get started in, whatever state I am founded in is domestic. That's where I'm incorporated. That's where I'm headquartered. That's where I'm at home. That is my home base. That is headquarters? Yeah, the headquarters, the main place. Okay. So domestic is where the insurance company got started and where they are selling. An insurer can only be domestic to one state. You can only be headquartered and founded in one state. So an insurance company is only domestic to one state. And the questions on the exam will be, they will only mention one state in the question. You know they're talking, you know the answer is domestic when they only name one state. An insurance company is incorporated in Illinois and they are selling in Illinois. What does this mean? They are domestic to Illinois. If they're headquartered in Illinois and selling in Illinois, they are domestic to Illinois. Only one state is mentioned. Now, that company may be domestic in Illinois, but they could be selling in Michigan. When they're selling in Michigan, they are known as foreign. Foreign says, I am not headquartered here. I'm headquartered back in Illinois. I'm incorporated back in Illinois. I was founded in Illinois, but I'm selling here in Michigan. I am now, the insurance company is foreign in Michigan because they're not homed there. They're not headquartered there. They're not based out of there. So any other state that the insurance company is selling in that is not their home is foreign. So this one will always come in as two states. An insurance company is headquartered in Illinois and they are selling in Michigan. Two states are mentioned. The answer is foreign. Living here or homed here, selling here, two states, foreign. So where domestic is, I'm selling here and I'm home here, domestic. I'm selling here, but I live here, but I'm selling over there, foreign. And then alien is completely outside the United States. So alien is in a whole other country. So if they mention another country, the answer is alien. So domestic is I'm incorporated here and selling here. Foreign is I'm selling here, but I'm incorporated over there. And alien, as I'm completely out of the United States, I'm in a whole other country. Okay. All right. Now, law of agency. So this is kind of going into your job as an insurance agent. Okay. So your job as an insurance agent. When you work for a company, when you're selling for them, you are under the law of agency. So the law of agency says well, first of all, I'm sorry. This definition here is not the definition of law of agency. The law of agency describes the relationship between the insured and the insurer. That's what law of agency means, but they don't ask really about that. What they ask is, what are the rules of the law of agency? And that's what this says. The rules is that an agent represents the insurer. So under the law of agency, which describes the relationship between the agent and the insured, that's the law of agency. It describes that relationship. The rules of that relationship are that the agent represents the the agent represents the insurer. Talking a lot takes my voice out. Okay. So the agent represents the insurer. What that means is, if I'm working for State Farm, I have State Farm on my polo. I've got State Farm on the front of my building. I work for State Farm. I represent State Farm. When a customer looks at me, they see State Farm. The agent represents the insurer, which also means I'm seeking the best interest for the insurer. I answer to them, not the customer. I don't have to answer to the customer. Well, I made this decision because I felt that it would be best. I don't have to do that to the customer. I have to do that to the company. I have to do this to State Farm. They're responsible for me. The other thing about the law of agency that they like to ask is that the knowledge of the agent is knowledge of the insurer. So just like I said, if I'm wearing the State Farm polo and the khakis and a customer comes to talk to me, whatever I am telling them, they're hearing from State Farm. Like, I am State Farm to the customer. I am State Farm in the customer's eyes. I am State Farm. So whatever it is that I am telling them, the knowledge of the agent is knowledge of the insurer. That's what they mean by that. That when the customer looks at me, any knowledge that I am telling them about their policy, about their coverage, is knowledge of the insurer. Okay. So law of agency describes the relationship between the insurer and the agent. The agent represents the insurer. Anything the agent does becomes the responsibility of the insurer. And the knowledge of the agent is knowledge of the insurer. Anything the agent says out of their mouth, the customer perceives that to be the knowledge of the insurer. Okay. Now, as an agent, you have authority. So this is called agent authority when you're reading your text, your online course, whoever you may have. But our ultimate study buddy, Angela, likes to flip it. She likes to say authority of the agent to really help you memorize that, to really help you get that in there. So think of authority of the agent. This is the authority you have as an agent. So as an agent, as a licensed agent, you have certain authority. You have power to do things. And you need to know all three types of power. The first type of power, authority, is express. Express authority is the power that I have that is written in my contract. So if it says you're allowed to do this, you're allowed to do that, you have power to do this, you have authority to do that, that is express authority. It is written down. It is in my contract. I know I'm allowed to do it because it is expressly written. It says so right here. It's express. It's expressly written. I can see it. I can read it. Express authority is written in the contract. I know I'm allowed to do it because it says so right here. Express authority is written in the contract. The next type of authority is implied. And this is implied by the insurer. So what I mean by that is they write a contract for the things that you're allowed to do for them. But they're not like, they would have to have like thousands of pages to write down every possible thing you may do for them. Okay. they're going to write down, there are certain things that they just assume that you can do and handle because you work for them. And that's implied authority. It's not written down, but we assume that you can do it. It's not in your contract, but you're going to have to do it. It's just part of the job. We imply that you have that authority. Okay. So this is power that is assumed by the insurer, but it is not expressly written. You don't necessarily need an example of that. You just need to remember that implied is assumed by the insurer, but it could be something as simple like your contract may say you are allowed to collect premium from your customers. And your customers would imply anybody that you sold insurance to. But what if your coworker's customer comes in and your coworker is out of town on vacation and the customer came in to make a payment? Are you going to say, I'm sorry, my contract says I'm only allowed to collect payments from my customers, and you're going to have to leave and come back in 2 weeks, and by then your policy may be canceled, but I can't take the payment for you because my contract says I'm only allowed to take payments from my customers? No, it is assumed that because you work in that insurance office that you can collect the payment from the customer, that you can collect payment from your coworker's customer. You know how to collect payments. You know how to issue receipts. You know how to do it all. So it is assumed that if your coworker's customer comes in to make a payment, you can collect that payment. Even though it is not expressly written, you are allowed to take your coworker's customers' payments. It's not going to be typed up in your contract, but they imply that you can do that. It's assumed that you can do that. Now, express and implied are real authority. It's real. It's factual. Express authority is written in your contract. Implied authority is assumed by the insurer, and they have the power to give you that. Apparent authority, the last one, is not real. It is perceived. And perception is how we think something is, but that doesn't mean it's true. And this is where we get into a lot of problems in life, because everyone has their own perception, and reality may or may not be your perception. Perception is reality, like what you perceive is true to you, but that may not be true to someone else. So perception is what we think is true based on what we're seeing, based on our past experiences, based on what we know and understand, but it's not actually true. So apparent authority is coming from the perception of the customer. The customer thinks you have this power, but you may or may not. Okay. So here is for example of apparent authority where you realize it's not real. It's perceived. We think you have that power, but you don't actually. Okay. Let's say you call up your grandma. Grandma, I'm studying for my life insurance exam. I'm going to be an insurance agent. I'm going to sell to you and all your friends. Make sure that you're well protected. She goes, oh my God, I'm so excited that you are going to be an insurance agent. I cannot wait. And then grandma goes to Vistaprint and she gets these beautiful insurance cards made up because she's so proud of you. And it says Rhonda, licensed agent. And she starts passing them out to her friends. You haven't even taken the test yet. And grandma is passing out business cards that say Rhonda, licensed agent. Every person who gets that business card in their hand is going to perceive that you are a licensed agent, even though you are not. You're not yet a licensed agent. You haven't taken the test yet. You haven't gotten your license yet. Grandma jumped the gun and bought business cards too soon, started passing them out, and now people believe that you are a licensed agent because it says on this little business card, but it's not real. It's perceived. It's not true yet. So this is where it is assumed by the customer to be true, but it's not actually true. This is where, as an agent, you need to be careful about what you say. If you tell the customer, oh, I can do this and I can do that, and I'll lower your premium, they're going to believe you to be true. They're not going to just assume that you're lying. They're going to believe you to be true. So if you say you have more power than what you do, you're effectually lying to the customer, then they're going to believe you. So just be careful with that. So the most common examples of apparent or perceived authority is business cards that were passed out too soon. Any letterhead, like if you were to send a letter to the customer, like maybe a customer came in for a quote, you had a great time, they left and they said, I might, or I will buy it or whatever. And then you write a handwritten note. You're like, you are so cute. I want to hang out with you. You're amazing. And you send it to them and it's got the letterhead. They're going to think it's coming from the company. They're like, oh my God, like if I don't date this person, is my premium going to go up? Like they could think weird things when you send it on letterhead, because to them, that's official business when it comes on a letterhead. And whatever it is that you said, they're going to perceive it to be official and true and from the company because it's on the letterhead or stationery. Okay. All right. Fiduciary. As an agent, you are known as a fiduciary. A fiduciary is a person of trust. A fiduciary is a person of trust. What you as an agent are being trusted with is collecting money from the customer and giving it to the insurer. So you are being trusted with collecting premium from the customer and giving it to the insurer. Okay. So fiduciary responsibility is collecting money from the insurer or collecting money from the customer and giving it to the insurer. That is your main job as a fiduciary. So when you think fiduciary, think funds. Funds are money, premium. The question may not use the word funds. The question may say premium or money, but funds are money. So fiduciary funds. If they're talking about funds, if they're talking about money, it's probably something related to fiduciary. Fiduciary funds. Another thing about fiduciary responsibility is you're not allowed to commingle. You're not allowed to mix money. Okay. If I collect $100 from the customer, I can't put it in my own wallet and spend it. I need to keep it separate. There is no mixing of premium and my money. I keep the money separate. Commingling would be mixing the money. You're not allowed to do that. All right. We talked about elements of a legal contract. We talk about all of this. Reasonable expectations. We missed that word. This one is just saying that if an agent, if you're talking to the customer, and this kind of goes to perceived authority, apparent authority. If you're talking to the customer, you say, you can expect this to be covered and you can expect that to be covered, they're going to believe you. And a customer can reasonably expect that that would be covered. So reasonable expectations, when they ask that question, they say, if the agent applied during the sales conversation that this would be covered, the customer can reasonably expect coverage. Okay, that's reasonable expectations. Okay, so we have covered all of these words. You've got the link for these, and if you're watching the recording, check below for the notes. So at this point, we're wrapping up general insurance. I'm going to go ahead and stop the recording.